Kia ora and welcome to episode 42 of Bridge Talks Business with Milford. China, it's our largest trading partner and the health of its economy is intimately linked to our fortunes. This week we're taking a deep dive under the hood of the Chinese economy to see how they're performing and by extension how we might perform over the next year or two. Milford's Will Curtayne is in the hot seat this morning, but first here's your top 5 business bits. Number 1, US inflation data last week, while increasing, was slightly softer than expected. For those fearing a tariff-driven return of inflation, this was something of a relief. Furthermore, it emboldened the Trump administration to up their attacks on Jerome Powell and the Federal Reserve. They're wanting a rate cut and they want it yesterday. Number 2, looking into the inflation data, there is clear evidence that tariffs are impacting prices, with goods prices accelerating at the fastest pace in a couple of years. This is likely to continue as more tariffs come on and take effect. The Federal Reserve are going to want more information before making a move on interest rates. Investors, by the way, expect those rates to remain unchanged at the next meeting next week. Number 3, whilst US retail sales slowed, consumer is still spending, which is good, albeit at a slower pace this year. One area of the economy being impacted by higher interest rates is the US housing market. Housing turnover at a multi-decade low, prices starting to flatten out there too. Number 4, Chinese monthly economic activity data released last week wasn't as bad as feared, but bigger picture, the Chinese economy has some structural headwinds. We'll get to those in a second with Will. And number 5, this week is a quiet week for economic data, with global business surveys the only thing of note. US company earnings season is picking up though, keeping investors busy digesting how companies are navigating the shifting economic landscape. Right, so great to have your company. This week, China's economy is growing at about 5% per annum, which sounds great, but it is expected to slow in the second half of this year. Part of the reason for this is they have some structural issues. They have some underlying issues going on in their economy, which they may need to, in the future, actually start to address. I'm joined on the podcast today by Will Curtayne, who's a portfolio manager at Milford, to talk this through. Just a reminder, this segment is informational only and should not be considered financial advice. Will, welcome back to the podcast.
Welcome, good morning.
Good to see you. So let's talk about some of these challenges that China's facing, the structural challenges, demographics. So not having enough babies and population ageing.
Yep, exactly. China's got a number of challenges, but it first can boil up to that lack of population growth. In fact, the population has been in decline for the last 3 years. China obviously doesn't get much immigration like New Zealand and Australia. Your birth rate's very low as a legacy of that one-child policy, and sort of policy changes to try and incentivise higher birth rates are not meeting with great success at the moment. So from a starting point, if your population's going backwards, clearly that's got issues for demand for housing and growth in your economy, among other issues as well.
Housing is another big sore point for them, right? Sort of an overinvestment in stock?
Yep, correct. So, we step back and look at China, since the 1990s, it's really been a hugely high growth economy. They began this urbanisation trend, locating population from rural areas to cities, and they built big apartments. China joined the World Trade Organization in the mid-90s, and that created an export boom. But they ran that model very aggressively, and they overbuilt in property and overinvested in property. And every time there was a slowing in the economy, they'd go pump a lot of money into and take on debt to build more property, which would keep the steel industries and the economy running well. But it got overdone. And debt in China has grown to 312% of GDP, one of the most indebted nations in the world. And 2 or 3 years ago, the property market peaked. Prices are down 25% since then, but new property starts or investment in new houses is down 75%. So that's a pretty material collapse in what was a very important industry in China.
Yeah. When you talk about debt, 312% of GDP, is that, who do they owe it to?
Most of it, fortunately, is sort of within the Chinese system. So that's total debt. So that's government debt, local government debt, business debt, and consumer debt. So it's spread among all those different groups. Yeah, the good thing for China is they don't borrow a lot of that debt from overseas. When countries borrow a lot of debt from overseas and they get into trouble, normally their exchange rate will collapse, and those countries struggle to pay off that offshore debt, but China's debt is within its own system, which does give them a few policy levers, if required, down the track to help deal with that debt burden. Mainly doing what the US and the Western world's done in the recent last 15 years is print money and pay off the debt.
Yeah, pull all the levers.
Exactly.
And China still has those up its sleeve. So, right, most of those levers?
Correct. They seem reluctant to want to use those levers at the moment, because if you're going to aggressively cut interest rates and do what we call quantitative easing or money printing, it would likely cause a collapse in their exchange rate, the Chinese renminbi. At the moment, while growth is slowing in China, while there are challenges, it's probably not dire enough for them to want to sort to those sort of measures. And if they were to do that today, and the Chinese currency would likely depreciate 10, 15, 20% or more, that would antagonise the US and trade relations, because a weaker currency makes your exports more competitive. And clearly the Donald Trump administration have got a big bee in their bonnet about trade deficits with China, and anything China did that the US perceived as
currency manipulation
would be a sign for Donald Trump to go and threaten even higher tariffs in China. So China's probably just going to try muddle through for the time being, but if push comes to shove, they have a lever to pull to help shore up growth.
So lots of potential solutions for them to some of the problems. But just coming back to those structural problems that we're talking about, what do they mean for New Zealand and Australia? Because we're obviously heavily reliant on them for trade.
No, good question. So when we go into it, I mean, the weakest industry in China is that new housing construction or the property sector. The consumer is cautious. They're saving a lot. Remember, there's no social backstops in China in terms of not much childcare, pensions, unemployment benefits. So when you've got this uncertain economy, a slowing economy, the consumers are saving. So from that lens, they're New Zealand's biggest export, clearly dairy products. We've seen a decline in the last few years of milk powder exports to China. But more at the head of it is New Zealand's second largest export to China is forestry products. And they've fallen 12% over the last few years, and probably likely to decline further, because a lot of the forestry exports, of course, are used in housing construction or related industries. So that's not the end of the world for New Zealand. It's just a slowing of a portion of our trade. It doesn't help the overall picture, but it's not a collapse either. If we look to Australia, Australia exports 37% of its total exports to China. Over half of that is iron ore, which is used in making steel. And of course, a lot of that steel goes into the rebar and building big apartments and so on. So volumes of iron ore have held up, but the value has fallen a bit with price. Again, not the end of the world for Australia, but it's just it's something that's been a tailwind for New Zealand and Australia for 15 plus 20 years. Is now not a tailwind. In fact, it's a marginal headwind to our total trade and economic growth.
So the question then becomes, what and when will China do something about it? They're cruising at about 5% growth at the moment. At what point do they start pulling some of those levers, which might, as you say, antagonise Trump or have other unintended consequences? Yeah,
no, it's a good question. I think over the second half and into next year, the growth rate will slow a bit, because growth in the first half of this year was actually supported by people front-running tariffs that the US is putting on China. So businesses went and tried to purchase as much of the goods in China as they can and get it to the US before tariffs hit. And that caused a mini boom in manufacturing exports in China. And they also had some consumer stimulus placed last year, which helped prop up growth in things like appliances and motor vehicles. Those tailwinds are going to fade in the second half. So we expect some minor stimulus measures in China, probably around the consumer, trying to give incentives for the consumers to go out and spend. That's probably just going to slow the pace of decline in growth rather than re-accelerate it. And we think China will probably, base case, next year, 18 months, muddle through before they pull any big levers like printing money and depreciating currency. They'll be hopeful that they can shore up growth without doing anything major. But if push comes to shove, I think they'll be forced to do it at some point, in the next couple of years. The other catalyst could be if relations between US and China completely fell apart for whatever reason. Then China probably has no reason not to go ahead and pulls the levers.
And at that point, we've all got bigger problems on our hands
Yes.
if their relationship fully fell out.
Yeah, clearly not the way we want it to go.
No.
Yeah, so.
Can they hope that global growth will help get them through that muddly year next year that you're talking about?
Yeah, it would all help. If global growth picks up, then China's exports should pick up to Europe and America, a couple of their key partners. But to a degree, some level of tariffs is going to remain. So that will cause a little bit of a headwind in any kind of growth and trade related to the US. One benefit for consumers in New Zealand and the rest of the world outside of America is as China reduces some of their exports to America, they'll increase their exports to the rest of the world, and we should get some cheaper goods
stuff.
prices. So it should help inflation in a lot of the countries outside of the US, which, fingers crossed, helps us with our interest rates. It's part of the world as well.
Yeah. And just to finish, in terms of investors looking at China as this, this beast that we've been kind of riding on the back of for the last few years, where does this leave investors when you're looking for places to put your money?
Yeah, so a lot of the world don't invest huge amounts of money in Chinese companies, either listed in Hong Kong or listed in China. There's a bit of that, but fears of relations between China and the US and China and the Western world have made people a lot more wary investing directly in Chinese companies. So normally you get it through proxies. So in Australia, the big mining companies like BHP and Rio have a lot of iron ore exports to China. We've got sort of smaller positions in those companies these days because the risks of iron ore prices being subdued due to the collapse in the Chinese property sector. And otherwise, it's these big US listed companies like Louis Vuitton and so on who sell a lot of consumer luxury goods into China, and of course those have been a bit weaker as well. So we're a bit more cautious on any listed company that sells too much for their products into China at the moment, until we see them pull these big levers or increase their kind of policy support to get that economy going.
That was Will Curtayne, a portfolio manager here at Milford, talking about the health of the Chinese economy, which of course has implications for us all. Now, don't forget you can like, follow, subscribe and rate this podcast wherever you like to listen. Until then, see you next week. Invest in yourselves.